National Accounting Talent Search Examination. So we'll have this presentation based on the curriculum, which is focusing on the junior level students, because National Accounting Talent Search Examination has got students in two levels, the junior level and the senior level. So this is now focusing on the junior level, which is meant for students who are pursuing BCom and BBA. It's an all India test, and we are going to give you an orientation. So good evening, and I'm Professor Simon Patel. I'm the head of the Department of Commerce, University of Kerala in the Karivattam campus. And we are presenting this on behalf of the Department of Commerce of University of Kerala, as well as the Indian Accounting Association Kerala branch. The Kerala branch is located in Trivandrum. Indian Accounting Association has 3 branches in the state and 57 branches across the country. And this is the Trivandrum branch is taking up this initiative. So, so this is the introduction, and I'll start off with the presentation, and then we will look into what we are actually discussing. Is the screen visible?
Yes, sir.
Okay. So, yeah. This is about the National Accounting Talent Search Examination. Now, you need to understand and know a bit about the Indian Accounting Association. This is a professional body, basically of teachers in accounting, finance, as well as professionals like chartered accountants and cost accountants. So across India, we have 57 branches and about 10,000 members. Their basic activities are research and having conferences as well as seminars in accounting, including model curriculum in accounting. They have their own journal called Indian Journal of Accounting. And one among the things that they do is hosting this National Accounting Talent Search Examination. So this is Indian Accounting Association. And now the Department of Commerce is a department, a teaching and research department of the University of Kerala. It was established in 1985. And basically they have programs. They don't have undergraduate programs. They have master's program, PhD program, and postdoctoral fellowship program. Now the master's program in the Department of Commerce is different from the master's program that you have in colleges. They have a different curriculum, and admission is based on entrance examination. Right now, the Department of Commerce, University of Kerala, has got 4 MCOM programs: MCOM in Finance and Accounting, MCOM in Global Business Operations, which is international trade, and MCOM in Blue Economy and Maritime Law. This program in Blue Economy and Maritime Law is interdisciplinary. Any graduate can join. Whereas other MCOMs, GBO and Rural Management are meant for BCom and BBA, whereas Finance and Accounting is meant for commerce graduates. So we have got 4 master's programs, in addition to the PhD program and the postdoctoral fellowship that we actually hosted. So this is just about the organizers of this event. Now, who can participate in the National Accounting Talent Search Examination? Basically, undergraduate students, and it's not just confined to commerce and management. Any discipline they can participate, but the curriculum is based on accounting and finance. So that's why it's more suitable for those undergraduates who are in commerce as well as who are in management. So essentially, these are the students who are eligible, and those who are pursuing this. So that's why they're saying what you have to give is an eligibility, proof of eligibility. You are going to produce a scanned attested copy of your mark sheet of 12th standard, or you can give because 12th standard for those who are in their first semester of their BCom program. And if you have finished your first year, you can give the first year mark sheet or second year mark sheet. So it is basically meant for those who are in the first to 6th semester of their BCom BBA program. This is what you're giving as a proof in order to indicate that you're still pursuing your BCom or BBA program. So in any other case, what you can do is you can give a certificate from the institution head which will be furnished, and they will verify that the applicant has not completed graduation, because this National Accounting Talent Search examination has got two levels. Level one is the junior level, which is meant for undergraduates who are doing their degree, and senior level is for those who have completed. So you have to prove that you are only pursuing your BCom or BBA, you have not completed, and based on that, you can take this examination. Now, this is the question pattern. You will have 100 multiple choice questions, and for this 100 questions, you will have 90 minutes. Each question will have 4 marks for the correct answer, and there is a negative marking. If you have a wrong answer, 1 mark will be deducted. So 100 questions, 90 minutes, 4 marks for correct answer, 1 mark for the wrong answer. The test is conducted online, so you can have your own laptop and with internet connectivity. There will be online proctoring. Your supervision will be done by somebody online who will be asking you to sit before the laptop in a particular within a particular space of visibility to them, and then you write the examination. Even sitting at home, you can do that. So it's entirely an online examination, and the details of this can be seen from the National Accounting Talent website, which is called accountingtalent.org. The registration fee is just 300 rupees. So just to give you a brief, anybody with 300 rupees can register for this examination if you are pursuing your BCom, BBA, or any undergraduate program. The test is basically focusing on accounting and finance, which is at the +2 and basic levels. So that's the content. We'll look at the content later. Now, if you get through, what are the awards that you're likely to get? The best performer at the national level. Remember, this is a national test. Best performer at the national level will get a cash prize of 21,000 rupees plus a trophy and a certificate, and they will be honored in the All India Accounting Conference each year, wherever it is held. So they'll be invited for that conference. They'll be given a trophy, a certificate, and 21,000 rupees. Second best performer, 11,000, trophy plus certificate. Third prize, which is 8,000, trophy plus certificate. And outstanding performance, or top 1% performers. That means you take the total marks that the students are getting. The top 1% of the students will get rupees 2,000 plus certificate. Then the branch topper, that means from which branch you are coming from, Kerala branch. So the branch topper will get 1,500 plus certificate. Brilliant performer, all 10% of the performers will get a special certificate. And rank from 50th to 90th percentile will get a certificate indicating that they have got this much percentile marks. Rank below 50 percentile, the lowest category, they just get a certificate of participation. So this is what you are going to get when you pass the examination. So this is a syllabus, just for a quick review. Most of you, if you look at it, you will find it's basically +2 content in accounting. It covers financial accounting cycle, including the journal, daybook, ledger, trial balance, adjusting entry, final accounts, rectification, bank reconciliation statement, depreciation, and non-profit organization, consignment, joint venture, insurance, partnership accounts, accounts for issue as well as for feature of shares, redemption of preference shares, then some basic concepts and cost concepts, including some basic knowledge of Indian accounting standards. So that's what it is. Now I'm coming to the content. So is there anything anybody wants to ask based on what I have given as the introduction to the examination? It is going to be held this year on February 5. The last date for registration is January 20. That is why we are giving you this orientation before that. So all those who are interested to take the examination, if you have not registered, register by January 20. Examination is generally held in the month of February of each year. This year it is on February 5, 2023. So anything anybody would like to clarify on this, you can do that now. You can get more details on accountingtalent.org. So I shared the curriculum, I shared the eligibility norm, I shared the fees, and I shared the awards. Is it clear? Shall we proceed? Those who are online, give me a response so that I can proceed. Am I audible? You can hear me? Hello, am I audible?
Yes, sir, you're
Yes, sir.
audible.
Yes, sir.
Okay,
Yes,
so
sir.
give me some response if you're with me. Otherwise, it is difficult to understand whether you're. So, shall I proceed with this? It's okay so far.
Yes, sir.
Okay, so we are starting with the accounting cycle. So, what is actually accounting? Accounting is actually recording transactions, classifying them, then getting the final results from it, preparing financial statements, and then interpreting financial statements. So, as simple as that. You have daily transactions taking place. You initially record it in the form in which it is actually taking place. Then you classify it. Then you see one more thing before I come to that. We cannot cover your entire curriculum in 4 hours. So this we are just giving you some tips on how to take a multiple choice question based on this. So the cycle is actually starting from your transactions. And I think most of you will be knowing what is transactions. You buy goods, you sell goods, you deposit money, you pay an expense, all are transactions. So once you have these transactions, we record, we classify, then we prepare financial statements, and then we go on to adjust those financial statements, and then you close your books, and the cycle moves like that. So it starts from actually this point where you identify transactions. Then you record it in a journal. Then you post it. So this is called this recording in the journal is what we call journalizing. It happens in the journal. What happens in the ledger is posting. It happens in the ledger. Then there are some you prepared a trial balance and you find some discrepancy. That's why it's called an unadjusted trial balance. Then you adjust it. What do you mean by adjusting it? You find out whether there are some errors or mistakes, maybe in posting, in balancing, in totaling. You correct that, and then you prepare the correct trial balance where you have a statement of all your accounts. Then you prepare the financial statement. What do we mean by the financial statement? We have basically two financial statements. One to tell you whether you have made a profit or loss. So keep in mind your questions in the objective type is not, you're not going to write a descriptive answer on what is an accounting cycle. You're going to write some of these things which come in the cycle. Say, for example, which of the two is a financial statement? Why? Which of the two financial statement is giving operating result? So operating result means whether you have made an expense or whether your income is more than your expense or your expense is more than the income. That is operating result. So which statement shows that? The profit and loss account. Whereas the balance sheet is giving your financial position. So these are the two statements which prepare. So at the end of the day or the end of a particular period, we would like to know whether we made a profit or whether we have sustained a loss and what exactly is our financial position. By financial position, what do we mean? How much assets we have, how much liabilities we owe, and how does it stand. Then you close your books at the end of the year and you get the result. So this is the accounting standard. You have a number of transactions taking place in a particular period. You journalize them, then you post them, you prepare your ledger, then you try it initially. When there are discrepancies, you adjust it. If there are no discrepancies, the initial trial balance or the final trial balance will be the same. And based on that, you prepare your financial statements. So this is something which most of you might have come across as far as the accounting cycle is concerned. Now, why are we calling this accounting cycle? Cycle means it flows like that. So once you close your book at the end of a particular period, what we are closing is only your revenue accounts. We close all expense accounts and all incomes accounts, but we don't close the accounts which appear in the balance sheet. They continue. And then it goes into the next period. Again, there are transactions. Again, recording happens, and this goes on over and over again. So that's the accounting cycle. Now we are talking about accounting concepts, conventions, which stand in accounting. Now, this is where you get a number of multiple choice questions. Basically, you might have studied this in your +2 classes as to what do you mean by concepts, what do you mean by conventions, and what these principles actually stand for. But what is important in your accounting talent examination is to identify a principle based on the multiple choice options given. So they are not going to ask you what is money measurement, or they are not going to ask you what is separate entity because you are not writing a descriptive answer. So which among the following issues will address separate entity? Which of the following issues is addressing materiality? So question will be on a kind of relativity based on examples. So you have to look at that example and identify whether this is an issue relating to a particular concept, if so, to which concept, or whether it relates to a convention, if so, to which convention. So that is what is required. Now, what we mean by these concepts, these are assumptions or notions, formulation of some accounting methods, where there is some kind of a judgment, but it is not a personal judgment, and it is prepared by accounting bodies, and it is prepared uniform across all entities. If we look at the essence of it, it is going to help in judgment, and it is developed with some kind of a uniformity across entities. What do you mean by this? See, before accounting came, before we had any form of accounting, look at the history. When we had small, what do you call, sole trading concerns operating within a village, there were small shops, and there was something like a barter economy. So there was no accounting with them. They used to remember what is happening in their memory. They used to remember for what amount they have purchased. They used to remember for what amount they have sold. They used to remember who are the people who should pay them. That means their debtors. They used to remember who are the persons to whom they should pay, their creditors. So all these things were there in their memory because the number of transactions were limited, the volume was limited, and the scale was limited. So essentially, at that point of time, there was no need of accounting. Then came a next phase where the transactions started growing. So what happened? People started writing it in books that I have spent this much, I have gained this much, I have given this much to this money, this person, I have purchased so much from some. They used to write it in the way in which they wanted. There was no common rules, regulations, nothing. But then again, when we moved from sole trading to partnership, and from partnership to joint stock companies, the number of transactions grew like anything. The volume became very high. And there was a need for somebody to come and look at the accounts, and there was a need to make your accounts made known to the public. Now, then came the need for having a uniform pattern. So that was how we are looking into the beginning, where Luca Paciolo, the Italian mathematician, started giving a design to it. In fact, it was this mathematician who said, let us draw books in a particular form so that everybody can understand. So you prepare an account, everybody can understand that this is the debit side, this is the credit side. It is all prepared upon a set of unified principles. So what are those principles and assumptions? That is what we cover under accounting concepts. And also, there are some conventions which we call the traditional practices, where we call application methods, where there are some personal judgments and things like that. So this is what we actually mean by accounting concepts and conventions. So we are trying to bring in a uniform set of practices, which is comprehensible to all, which everybody can understand. And if you present your accounts, everybody knows what is the financial statement showing, what is the balance sheet showing, because balance sheet has a common set of principles. So this is the whole idea of having accounting concepts. And still, the latest development is that maybe when we talk about 2000, 2010, we had a set of practices which was common for one country. So we had what is called generally accepted accounting principles. We call it GAAP, GAAP for India. Then we had a generally accepted principle for UK. Then we had a generally accepted principle for USA, or we used to go in that form. Now we have what is known as internationally accepted accounting standards, which is called as IFRS. So for the last maybe 5 years, 6 years, or maybe 10 years, we have started unifying it even universally, because across the world they must have the same concepts and principles in preparing their accounts. And that concepts and principles is what we call International Financial Reporting Standards. So I've just traced the origin from absolutely no recording, stage 2, recording, but in the way in which you like it, stage 3, recording it with some basic common principles, where we started having an accounting body, that accounting body telling us that the profit loss account and balance sheet should be like this. But at that stage, generally accepted accounting principles was for each country different. And now we are moving into a stage of IFRS, International Financial Reporting Standards, where we are trying to make it uniform. Now, as I said, in your objective type, basically in the first part, many of your objective type MCQs will be based on concepts and conventions. So let us try and look at what they are, accounting concepts. Now, these are things which all of you know, like what is going concern, what is accounting period, what is cost, what is realization, what is accrual, what is matching, what is duality, what is business entity. So these are some of the concepts. But then you will not be getting, as I said, a question on what is business entity, what is duality, what is matching, what is accrual. But you will be getting certain questions where you will be asked to relate these concepts to the accounting process which you have learned. So I'll just quickly give you some examples where it happens. Say, for example, when you say going concern, what do we mean by that? We prepare the accounts of a business with continuity. You just saw the accounting cycle in the previous slide which I showed. What do you mean by this continuity? We are preparing the books of accounts in such a way that we believe that the business will go on and on. So that is why you have your balance sheet, real accounts, and your real accounts are closed and it is continued in the next period with the balance that is existing. So we always look at that perpetuity, the continuity, which will be there in your accounting process. So that is what we mean by going concern. So that is the reason why we are actually looking at a concept of finding out the profit or loss at the end of a particular period, finding the financial position at the end of a particular period, and continuing with that for the next period. And it goes on and on. So this is what we mean by going concern. The second concept is accounting period. Now, earlier when we never had something like computerized accounting period used to be a year. So either take the financial year. So you say it starts April 1, ends in 31st of December the next year. That's an accounting period. But you can have even shorter accounting period. Say, for instance, I want to prepare the profit and loss account and find out what happened in 3 months or what happened in 6 months. So I have my statements balanced and prepared for that period. So whatever results you're talking about always pertains to a particular period, which is predefined. That's why you have your financial year results or first quarter financial year results, so on and so forth. And there is a concept called what are we actually recording? We are recording the cost which has been actually incurred in something. So that's why we say we are looking at what has been actually expended in order to get a benefit. That is what we call as expense. So cost is those things which come there. And when do you actually recognize this or realize it? That point is what we actually talk about, realization. Accrual talks about the due concept. What do you mean by due? In accounting, normally we want to know the profit which has happened in a particular period, the accounting period. Suppose my accounting period is 1 year, then I must take all expenses and all incomes which have happened in that year, irrespective of whether you have paid it or not. Suppose there is a rent is an expense, and I don't pay rent, I pay only for 5 months. And next 7 months I don't pay. So my books, if it shows only 5 months rent, what will happen? The profit for that period will be understated because I have shown only 5 months rent. Out of 12 months, I'm showing only 5 months rent. And the profit is now overstated because one expense is less. And what will happen in the next year? Next year, you will have to pay that year's 12 months rent plus the 7 months which you did not pay in the previous year. So that year's profit is going to be understated. So in order to avoid this, we have an accrual concept. So what happens in accrual concept? Accrual concepts are bringing the amount to the payables and receivables. This is something important for your MCQ. We don't account what has been paid and what has been received. We account for what is payable and what is receivable. Suppose interest is due for me in 1 year from my bank deposit. If I don't get that interest and I don't record it, then that year's profit gets understated. So even if I don't get it, I write it as accrued income. Even if I don't pay, I write it as an outstanding payment. If I have paid more, I write it as a prepayment which has been made by me. So I bring all the figures. Why are we using actually adjusting entries? We are using adjusting entries in order to bring the figures from the paid to what is payable. That is why we have outstanding expense and prepaid expense. Outstanding means what is due, we are bringing that into account. Prepaid is what is not related to this year, we are removing it. Similarly, what is received, we are bringing it to the receivables. So if we got an income and there is some income which is yet to come, we say it's accrued income. If you got more than what is due, you say income received in advance. So this is the concept of accrual. So what happens as part of accrual? We pass adjusting entries in order to make the figure the payable figure and the receivable figure rather than the paid figure and the received figure. So that's what is actually happening there. Then what is the matching concept? We are matching your revenue with your expenses and finding out whether we have made a profit or a loss. So profit means your revenue is more than the expense. Loss means your expenses is more than your revenue. Now, duality is actually talking about two aspects of a transaction, because when somebody is buying, another person is selling. When somebody is paying, another person is receiving. When some expense is incurred, there is something which you get as a service from somebody. So these are the things which actually come. Business entity talks about business and the owner being separate. This again can come as an MCQ, where they're asking what happens in a transaction as a result of business entity, or what is actually coming in terms of business entity in your financial statement. What comes there is your capital account. Capital is shown on the liability side of a business. Now, suppose it is my own business. Why should I say that the capital is something which the business owes to me? Because I and my business are the same. But the concept here is again that the concept here is talking about the business and businessman being separate. So what is the capital? Capital is the amount which the business owes to the businessman, even though they are one and the same. That is called separate entity. So why capital is shown on the liability side? Because of the separate entity concept. And finally, money measurement, you can put in accounting only that which can be expressed in terms of money. Say, for example, you cannot record loyalty. You cannot record morale. These are the concepts which might have value, but you cannot put it because it's not capable of being expressed in terms of money. So which of the following are things which cannot be recorded? Or one among the following which cannot be recorded? You must think for something there which is given as something which cannot be expressed in terms of money. So these are the certain concepts which actually you need to keep in mind. So essentially, these are all, suppose you're saying going concern, that is the reason why you're continuing your accounting cycle. You're saying accounting period results are applicable to a particular period of time. If you're saying accrual, it is the concept where you're saying adjusting entries are passed and the actuals are brought into the payables and the receivables. You're saying matching, we're talking about revenue versus expenses. When you're talking about duality, we're saying two aspects of a same transaction. So these are some basic concepts which actually get reflected when we discuss accounting concepts. Now, what are the conventions? This is again important for your examination. It won't come as what is conservative. The conventions are conservatism, consistency, full disclosure, and all. What you actually mean by that? So conservatism means we are becoming conservative in our approach rather than becoming very following a very aggressive or optimistic form. You cannot do anything in business with a sense of optimism. That means your profits or would-be's are recorded only when they are realized. But you can anticipate a loss. So conservatism actually means anticipating a loss. Now again, what happens as part of this in the transactions and in the financial statement? You make many provisions. Provision for bad debts. We are anticipating that some of the credit sales that you made, you might not get it back. It will turn out to be bad. And in anticipation of that, you are making a provision for it. So you are becoming conservative. You are anticipating a loss. discount on the discount that you might have to pay. You're making a provision for that. Provision for certain legal issues which might come against the business. So anticipating certain losses, you can do something in your financial statement. Those are the examples which I now gave: provision for doubtful debts, provision for bad debts, provision for discount. These are things which you can make. You can anticipate a future loss and make some amount or set aside some amount to meet that. This is allowed, but you cannot anticipate a gain. Say, for example, suppose you say we have taken a lottery ticket and you're anticipating that first prize will come. So maybe this will come and therefore I'm putting it as an anticipated gain in future. This cannot be done. So gains are actually taken into account only when they are realized, the realization concept, whereas a loss can be anticipated. That is what we mean by the concept called conservatism. Now, what is consistency? Now, there are certain things in accounting where the principles can vary. However, when you follow a particular principle, you cannot just freely go on changing between principles within an accounting period itself. Say, for example, suppose you're making your books, you're balancing your books in the financial year. Next year you're saying ours is a calendar year. Then again in between you're saying it's a financial year. So the accounting period becomes incomprehensible. So you must be consistent over what you're choosing as an accounting period. Say depreciation again. There is a fixed installment method, there's diminishing balance method, there are different methods. And you are free to choose a method. But when you choose a method, you must keep that method with you at least for a reasonable period of time. You can't say that first 6 months I'm fixed balance, next 6 months I'm diminishing balance. So you're becoming inconsistent. So consistency actually means you're bringing these things into count. Again, full disclosure. Now, what happens as part of consistency? Your MCQ, they might ask, should the depreciation principle or the accounting period principle is kept same for a reasonably long period of time? This is according to which convention or which principle it is consistent. Provision for that debts is allowed in the business according to which of the following? It is because of conservatism. Now, full disclosure means the idea behind financial statement. If you look at the accounting standards, there's a standard which talks about full disclosure. How, to what extent, and to what depth do you actually disclose? We must give as much of detail as possible. And this disclosure goes on getting enhanced when the nature of the business varies. Like the amount of disclosure in the financial statement for a sole trading concern, which does not have any mandatory statutes or registration, will be relatively less. Partnerships still higher. Private limited companies still higher. Public limited company will be the maximum. So if you look at the balance sheet of a public limited company, they even talk about salary. When you say salary, a sole trader will be just giving the total amount of salary spent in 1 year. But then this in a public limited company or a statutory corporation, they will be talking about divisions of the salary. For how many people draw salary above a certain limit. So they are disclosing it in greater detail. Now, when you look at a sole trading concerns balance sheet, they'll be just disclosing cost of an asset, less total depreciation. But in the financial statement of a corporate entity, it will be also talking about the original cost, detailing of the different acquisitions which have taken place and details of the depreciation. So they will be giving it more detail. So full disclosure means disclosing the entire details of what has actually happened in an accounting period. The financial statement must be self-disclosing because the objective of the financial statement is to help others to take a decision. Somebody wants to decide whether to take over this business, whether to buy shares of a business, or to understand whether this business is good or bad. They need to understand the profit and loss account and balance sheet with its full details. So this is what is called full disclosure. Again, materiality. This talks about the material facts. Every financial transaction must disclose material facts. Say, for example, again in your MCQ, you might get a question that when cash sales are made, we record cash, but we don't record the party from whom we have purchased. When credit sales is made, or credit, same with purchases, credit purchase or credit sale is made, we record the party from whom we have purchased or the party to whom we have sold. Now, the idea here is the party is material when it is a credit transaction. But when it is a cash transaction, I need not remember the party at all. Suppose I have purchased goods from A for cash. Purchased goods from A for cash. That means I paid cash and I purchased goods. Now the A is immaterial there. Cash is material and A is immaterial. But suppose I purchase goods on credit. Then for me, I've not paid cash. So cash is immaterial there and A becomes material. So in different types of transactions, what is material is based upon the nature of your transaction. Certain things might become material and certain things might become immaterial. So this is what we actually mean when we are referring to the concept of materiality. So keep in mind, accounting concepts and principles collectively will refer to these conventions like materiality, full disclosure, consistency, conservatism, which all has got something to do with your transactions and the financial statement. So also the previous concept of a separate entity, going concern, money measurement has got something to do with the transactions and the subsequent preparation of financial statements, which you do in your accounting process. So we have to conceive this well in order to take the different types of questions which might come as MCQs for this particular examination. Now, you have to decide the dual aspects. So your accounts, if you look at anything that happens in the business, it will either be something which is related to some assets that you buy and sell, or some parties who come in, or some expenses and incomes that come in. So for all that we take it in the form of assets, we call it as real account. So it is, say, for example, I purchase land, I purchase machinery, all these are real accounts. So what the rule there is, what actually you know, they're not going to ask you the rules, but you need to know the rules in order to see how they will, what I've shown on the side here, the journal, how it is actually recorded here is based on these rules. So you are not going to be asked anything on the rules, but conceiving these rules is required for writing up this journal in this particular form. Now, this format is not as such followed now because when we go by the computerized accounting, the same principle is followed, but recording might not actually be in this exact form. So we are just giving an example here. Now, when I'm saying purchase to Y and company, what does it mean? This entry shows that a party's name is given. I have purchased from a party, Y and company, which means by materiality concept, here it is a credit purchase. That's why I recorded the party. I didn't record the cash. So also the next one, D and company, Y and company. So when I'm saying purchases to cash, it means that the Y and company from which I have purchased is immaterial because I have paid the cash. So these are the rules. Debit what comes in, credit one, debit the receiver, credit the giver, and debit what all expenses and losses, and credit all incomes and gains. So you also need to know what actually is the difference between expenses and losses, and what actually you call as expense and expenditure. Now, when you say expense, what we mean is something which is in business, we don't incur anything without any anticipated benefit. Just like, say, for example, even when you're saying donation, it must have been given for some gain. So when you spend money, keep in mind that there is an anticipated benefit. And anything that you actually spend with an anticipated benefit is what we call an expense. So for example, when you pay salary, you forget the person's service. When you pay rent, you must get the service of using a particular building. When you pay for goods purchased, you are getting the goods for you. So this is all that we are talking about in terms of expenditure. In terms of expenses. Losses, on the other hand, are things which are not purposive and without anticipated benefit. In expenses, the two features that we are talking about is, number one, it is purposive, deliberate. It is not accidental. So they might ask you a question like which among this is deliberate and which is accidental. Say, for example, when you're saying salary, you don't pay a salary accidentally or without a purpose. You know when to pay, you know whom to pay, you know how to pay, you know how much to pay. So it is very deliberate and you have a benefit to come. So it's an expense. But when I say loss, it does not happen with a purpose. It happens in an unanticipated form and there is no resultant benefit. Say, for example, loss of stock by fire, loss by theft. Both these are debited into your profit and loss account, but they are different in the sense that loss is not deliberate and loss does not happen with an anticipated benefit. So this is the difference between expense and loss. Now, what is the difference between expense and expenditure? Expenses are actually revenue expenses, whereas expenditure are capital expenditures. So what do you again mean by that? I said when you are incurring something in business, it is with an anticipated benefit. Now, your accounting period will talk about when does this anticipated benefit come. If the anticipated benefit is coming within an accounting period, then you call it a revenue expense. If it goes beyond an accounting period, you call it a capital expenditure. Normally in your books, you will say that amounts which are small is expense, amounts which are big is expenditure, amount which are recovering is expense, and amount which are non-recurring is expenditure. It's true. But then these two things are slightly related. What is small and what is big for a small shop to a multinational company might vary. So invariably, we can use this common rule. Expenses are those from which the anticipated benefit expires in the accounting period. Now let us look at some examples. Suppose you pay rent. You might pay rent for 1 month. You might be continuing to use the building, but each month you pay rent for that particular month. You might pay salary for 1 month or wages for 1 day. You don't pay beyond an accounting period. So when you're saying interest, you get interest for 1 year. You don't get it beyond 1 year. So these are all things where the benefit is expiring within the accounting period. Therefore, it is called revenue. On the other hand, suppose you're saying you purchase plant, machinery, building, land. The benefit for that does not expire in 1 year. It goes several years ahead. And that is why it is called capital expenditure. I hope I have made myself clear. So capital expenditure are those for which the benefit will go beyond the accounting period, whereas revenue are those for which revenue expenses are those which will actually uh, made for the benefit comes within an accounting period. So these basic things and the rules will give you something like a journal. Now, what is the uniqueness of this journal? It's something like your diary. You look at this, you see the date, March 1, then March 2, then March 3. So it is called a day book. It is also called a book in which transactions are recorded in a chronological order. Or yet another way, you're recording this in the course at which it happens. If you first purchase from one company, you'll write this. Again, if you have 10 transactions in the same day, you'll write what happened in 9 o'clock, what happened in 9:10, what happened in 10 o'clock, 12 o'clock. So just writing, finding out the debits and credits, or you're just making a chronological presentation of all that has happened in a particular day to a particular year. So it's just a chronology. That's the first book. And the process under which you're recording this, based on the rules and debit and credit, is called journalizing. So journalizing is the process and journal is the book in which you're writing. It's just a day book, something like a diary. We're just writing the debits and credits. There is no classification. You're going on writing the entries the way which actually happens. That's the first book. Now we come to the next book where you have, so these journals, one more thing here, your curriculum talks about a common journal where all the transactions are recorded. You can have a day book which is again split like this. All credit sales are recorded in the sales day book. All credit purchases are recorded in the purchase day book. All returns of goods, purchase returns book, sales returns book. All cash and bank transactions are recorded in the cash book. Or small cash transactions are recorded in the petty cash book, and then you have a remaining transaction, which come in the journal proper. So instead of one book, you can get it classified into these different forms, and you can put it in that particular phase. So here's an example of how you are actually preparing. When you are done all this, you get a statement like this. After you prepare this and you classify all your accounts, you get something like a trial balance, which shows all the debits. Initially, based on this, you had several transactions which have been debited. Say in the first case, purchase was debited, B and company was debited, Y and Co was debited on third, bills receivable was debited on fourth. So there are when you just close this and start balancing, you'll have a number of accounts with debit balance, a number of accounts with credit balance, and they will agree. That is what is called a trial balance. So it is a trial balance is actually a statement prepared on a particular day. The day you want to test the process into it does not show the results of the financial position. Keep that in mind. It is a position statement, but it is just positioning your journalizing and posting process. It is just testing whether your journalizing and posting is correct. If you have put a wrong debit or a wrong credit, or you have taken a wrong total, or you have not posted one ledger, then this will not equalize. The trial balance will not equalize. So what is the purpose of the trial balance? To test whether the first part of your accounting is correct, or it is at least what we actually try to call speak about arithmetically correct. That means your totaling, balancing have all been correct. So that's the only purpose there. So when you actually reach this stage, we say that there actually the bookkeeping part is ending. Then the rest of it, that is profit and loss account and balance sheet, is what we call the accounting part. So basic understanding of this is something which is very important for you. So what is actually tested in your preparation of the day book, whether you know which transaction is to be debited and which transaction is to be credited, and the order in which they are taken place. That's all. What happens in the ledger? You bring all cash to one place called cash account, all credit sales to one place called sales account, all your purchase returns to one place called purchase returns account. So you have several accounts there. Some of which will be showing debit balance and some of which will be showing credit balance. So that is what is shown here. You have this the accounts then, and when you take all your accounts together and put all the debit balance and credit balance together, you're testing the arithmetic accuracy. So again, to this stage, what happens? Journalizing, you have the journal. Posting, you have the ledger. And finally, testing, for which you have the trial balance. And testing is a position statement. It's not position statement, it's on a particular day. In this example, we are saying that this trial balance was prepared by Go Green Private Limited. It is as on 31st March 2019. So they made a test on 31st March 19 with all their accounts, and they found that the result shows it's same. So debit, because dual aspect says every debit should have a corresponding credit. If I purchased from A, I have incurred an expense in the form of purchases, and I have a party to whom I have to pay A. So suppose they are saying purchase from A and there is no mention about cash, which means that it is a credit transaction, in which case A is material, cash is immaterial. Is it okay so far? Anybody wants to ask anything at this stage? Any issue which you would like to clarify at this stage? Okay, so we'll continue with the rest of it. Now we are coming to the different, in addition to the normal entries that you have, in addition to the normal debits and credits that you have, there are some different types of entries which are used for different purposes. Now, why are we using these adjusting entries? Keep this in mind. When a transaction takes place, you write it in the journal. Suppose you pay rent, you write rent account debit to cash. Suppose you buy land, you write land account debit to cash. Suppose you sell goods for cash, you write cash account debit to sales. So in the journal, things which have happened as such are recorded. Now, as I said earlier, there is a concept called accrual, which says that it is not that you have incurred a loan that should be recorded. And that comes out when you prepare the financial statements. That means when I prepare my income statement, which is a profit and loss account, what is important? I must bring into that profit and loss account all expenses which are due, which have accrued on a particular, up to that particular period. All incomes which we have gained in that particular period, not all income which we have received in that particular period, or all expenses which we have paid in a particular period. So the journal is giving only what has been paid or received. It does not say what is due. It is only saying what you have paid. Now, I'll just give one example so that you get that clear. Suppose I have taken a building on rent for rupees 1,000. So that means at the end of the 12th month, 1,000, 1,000, 1,000, 1,000, there will be 12 entries. Suppose I am paying rent on the 1st of every month. 1st April, rent account debit to cash 1,000. 1st May, rent account debit to cash 1,000. 1st June, rent account debit to cash 1,000. So that there will be 12 entries. But what will happen if I am not paying rent for 2 months? This entry will come only 10 times. And if you balance your rent account, it will show rent account a balance of 10,000 rupees. But the problem is, according to the accrual concept, the value should be 12,000 in the profit and loss account. So it is here that adjusting entries come. That means adjusting entries are entries which are used to record that which has not come in the journal. In the basic journal, what has come is only what you paid and what you received and what has actually happened. But in the income statement, your profit and loss account, you will have to bring them to the payable amount and the receivable amount. Again, in the same example that I gave, suppose I pay in advance the rent for the coming year. Rent each month is 1,000 rupees. I pay rent for 12 months, and in the 12th month, I pay rent for the subsequent year. So instead of 1,000, I pay 13,000. 1,000 for that month, 12 months for the coming year. Now, if I balance my rent account, I will see a balance of 24,000. Whereas the actual expense for that period should be 12,000. So what should I do? I must reduce this and bring it back to 12,000. Your journal is showing 24,000. So journal can show an amount which is less than what has actually been paid, or which is more than what should be actually paid, because it's based on actuals. Whereas the profit and loss account should not include the actuals, it should include what is payable and what is receivable only. How do you adjust for this? We adjust for this called entries called adjusting entries. So basically we have 4 types of adjusting entries, or even more than that for that matter. Fundamental 4 types of adjusting entries are to record accrued revenue. That means revenue which has been gained, but not put in the, not received in cash. So it has not come in the journal. Suppose interest is 1,000 rupees per month. So I write cash account debit or bank account debit to bank interest, 1,000. But after 5 months, I have not received it. It is receivable, but I have not received it. So my my interest account will be showing a balance of 5,000 rupees only, whereas I must get 12,000 rupees. So I must enhance the interest from 5 to 12. So do I write accrued interest to interest account 7,000. So the interest gets enhanced to 12,000. So essentially, what are we doing there? We are bringing the revenue to the level to which it has to be actually received. So suppose if I get 5 years rent interest together, interest will be very high. So I say the interest is actually relating to an income that we have received in advance. Same with expenses. As I said, it might be outstanding expense or it might be prepaid expense. So also you must make adjustments for the depreciation, for the bad debts, for the provisions that you make for doubtful debts. So these are the adjusting entries. So after the journal is prepared, we find some discrepancy in terms of some adjustments which are required. These adjustments are essentially bringing values from what has been paid to what is payable, from what has been received to what is receivable, and some subsequent adjustments which are required for deferred revenue or for doubtful debts that actually turns out to be important. So this is what is actually adjusting entry. So what is the purpose? What is the concept? Accrual. What is the purpose? Why are we saying it's adjusting entry? Because we are adjusting the figures to what it should be. Adjusting rent, adding on to it outstanding rent. So then what happens? Rent account to you're saying rent account is outstanding rent. So outstanding rent is it is giving more value to the rent. So that way you have to find out the mechanism for adjustment entries which are actually looked into. So just like adjusting entries, we also have something closing entries which are actually meant for closing the books of accounts at the end of a particular period. Now there is again in your syllabus something called errors. So before we start, let us understand that there is always a difference between error and fraud. Error and fraud. Now, in the accounting process, it is very difficult to detect frauds, but it is very easy to detect errors. The difference between an error and a fraud is an error is something which happens unknowingly. It is not deliberately committed. Whereas a fraud is deliberately committed. Suppose I want to put an expense which is not a real expense. I am saying that I paid an amount of rupees 10,000 to A, who I am saying is an employee. But the fact is, I have not paid this, and there is no employee called A. This is a fraud. Now, this cannot be detected because I put in the profit and loss account salary, which I am showing as paid to A, and I am taking that amount out. Very difficult to detect. So there is a difference between errors and fraud. One is made deliberately with an intention to deceive. Not that it cannot be found out. There are ways through which you do your vouching, verification, valuation, and then find out. But through the natural accounting process, it does not get detected because there's no discrepancy in salary. I have put salaries paid for these many people, and the salary should. So which is easy to detect? Errors. Why are we saying it's easy to detect? It happens unknowingly. I'll just give some examples. You did not record one entry. One transaction was not recorded. Or one transaction which was incurred for 100 rupees, unknowingly it happened that you put it as 1,000 rupees. Or you're talking about rent was an expense, but unfortunately you took it as an income. Instead of saying rent paid, you consider it as rent received. So instead of debit, it goes to a credit. So in all these cases, there are errors which gets disclosed because by and large, your trial balance through which you are testing these balances, it will show a difference. But there are some errors which might not get revealed by the trial balance. So first you need to know what are errors. Then you need to understand which are the errors which will get revealed by the trial balance because trial balance is not agreed, and which are the errors which are actually those which get revealed by the trial balance, disagreeing of the trial balance. Error of principle means your error is happening because you have gone wrong in the rules of debit and credit, revenue recognition, or real account debit credit. The rules you are not following, the principles are not being followed. Say, for example, I said materiality. I purchase goods from A for cash, and I'm writing an entry purchases to A. This is against materiality. I purchase for cash means purchases to cash. So there's a wrong principle is not followed. You're not following the principle of materiality. Or one aspect is recorded, one aspect is not recorded. Debit is recorded, credit is not recorded. Here you are going against the principle of duality. Or something which is not in the kind of money is recorded as money transaction. You're going against the principle of money measurement. Or you're not writing any adjusting entries and bringing the amount based on outstanding rent or outstanding expenses. You're going against the principle of accrual. So these are errors of principle, which might happen unknowingly. Clerical errors are things which happen because either you don't record or you record in the wrong way or you total in a wrong way, or you enter an amount less or more because of 10 being high or 10 being low. Now remember, such errors occurred more when accounting was manual. When accounting is computerized, the journal amount automatically moves into the ledger, and the ledger amount automatically goes into the financial statement. So there's no manual entry. So say the mistake that I said, when you put 100, 10 goes more. Such things are not likely to happen because the initial feeding itself will take the entire system throughout it, and there's no chance of having totaling mistakes. So this is conventionally an error which happens more when things were in a manual format. So clerical errors are those in which you have error of omission. Means an error of omission is two: complete omission, partial omission. Complete omission means you're not recording debit, you're not recording credit. One full transaction is omitted. This will not get revealed by the trial balance. If you write debit and don't write credit, trial balance will show difference. But if you come, so which among the following errors will not get revealed in the trial balance? Error of total omission will not get revealed because both is not entered. Trial balance will still tally. But if there is partial omission, it will get revealed by the trial balance because you recorded the debit, you did not record the credit. Similarly, error of commission. This is basically error in recording, error in the posting. It will get revealed by the trial balance. You posted on the wrong side, or you posted a wrong amount, or you're doing a wrong carry forward. It will get revealed. But compensating errors again might not get revealed. In the debit, instead of 100, you put 10. So there was 90 rupees short. But in another transaction, in the credit, instead of 100, you put 10. So there's a credit also gets, so one error gets compensated by another error. And when the compensating error happens in opposite direction, but debit is short, credit is also short, it might not get revealed. So this is again cases where the revelation might not actually happen. So these are the different, what do you call, kinds of errors which might creep in into the process of, and you can get these errors rectified through journal entries. Just like I said, that after preparing the journal, you pass some adjusting entries for bringing the figures into the accrued amount. You pass certain rectification errors in order to see that this is recorded. Say, for example, total omission. You find that one purchase for 1000 rupees for cash is not recorded. So you make a record for that. Rectification entry will be recorded when you find that this is not recorded. Or when you say that the debit is recorded but the credit is not recorded. So you put ensure an entry of rectifying it by making a credit to that. So these are the things which actually get done. And these rectification errors are passed when the trial balance, which we saw here, does not agree. The trial balance is not agreeing, you put that amount as a suspense to the side where the disagreement is. And then you look at the reasons for that suspense. You cannot prepare a financial statement with a suspense account. So with that difference, you go on searching why one transaction was not entered partially, or there was a totaling mistake, or there was a compensating mistake. And when those things are entered through rectification entries, the trial balance becomes, that's called an adjusted, corrected trial balance. And with that corrected, adjusted trial balance, we go for the preparation of what is called the financial statements. Okay. Now, before coming to the financial statements, in your curriculum, there is something called a bank reconciliation statement. So why are we preparing a bank reconciliation? I'll come to the financial statement a bit later after discussing something on bank reconciliation and thereby depreciation. What is a bank reconciliation statement? The word itself is talking about reconciliation, reconciling between. When you say reconciling, it means that two things are not in agreement. And now you want to bring them into agreement. You're trying to create a reconciliation. So that is what is actually talked about bank reconciliation. And what is actually happening here? A business has some banking transactions. It opens an account with a bank and it makes some payment by check. It gets some amount directly into the bank account. So there is a transactions which are taking place between the business and the bank. So at any point of time, the business would be preparing a bank account. or a cash book with a bank column. And parallel to that, almost reflecting the same thing, the business has a passbook, which is a replica of the bank account, which is maintained by the bank. So bank account will maintain a passbook or a customer's account with the bank, and the customer will maintain an account for them with the bank. Now, at any point of time, these two must tally. Suppose I say that in my business, I put 10,000 rupees into the bank. Then I'm saying that in my bank account on the debit side, I put to bank 10,000. That very day, when I'm saying in my bank account, 10,000 rupees is going into the debit side because I made a deposit. When the amount goes to the bank, in the passbook, my passbook, in the business's passbook, there will be a credit for 10,000. So this debit and that credit. My debit balance is 10,000, passbook balance is 10,000. It is tallying. Now let us look at what happens in certain cases. What I've shown here is a cash book, which is showing the bank column. The bank column is actually dealing with the bank transactions. Cash column I have not used. We are talking only about the bank column so that you can understand the reconciliation process. What you see in red on this side is a bank passbook. Bank passbook will show, instead of saying debit and credit, they use the word deposits and withdrawal. So deposits actually stand for the credit, withdrawal stands for the debit, and the balance. So now let us look at transactions. Please just try and understand how this works. This is the first transaction. You're talking about the initial balance that you had, which is 50,000 on December 1, 2022. And in that day, you also have a balance to your credit of 50,000. So there is no difference. It is agreeing. Now look, one more transaction is happening there. You paid your salary by check, rupees 2,000 on 2nd December. So since you paid by check, in your account, you show it as gone from the bank on the credit side. And on that day itself, the check was deposited in the bank. Suppose you pay salary to Mr. A goes and puts it in the bank account and takes it from our bank account. So you pay 2,000, the very same day, withdrawal, debit 2,000. So credit here creates a debit here. Again, there is no disagreement. If you balance this 50,000, 2,000, 48,000, so here also the balance is 48,000. Now I'm going on with this, just keep watching. Another transaction. What happened? You again gave a check on 3rd December to a party, rupees 1,000. But it is not presented in the bank. Look at this. So now on your credit, you are saying that I have given a party a check. But that party is not deposited in the bank. So since the bank did not get any notice of this, your balance has been credited by 1,000 and your account balance gets reduced by 1,000, but there is no corresponding entry here on that day. It might happen subsequently, but on 3rd December, nothing is happening. So here there is a difference. At this stage, if you look at your cash book, it will show 50,000 on the debit side, 2 plus 1,000 on the credit side. This is your debit side, and this is your credit side, and the balance will be 47,000. But here on this date, December 3rd, you are seeing that it still continues to be 48,000. So 1,000 rupees there's a difference. And the difference is because this person's check did not come to the bank on the same day. Now look at the next, another transaction to check number 1 not received. Now a party gave us a check. Some of the reasons where differences are coming, this is your MCQ. Check was given to a party who did not deposit it in the bank. So my amount, I am paying check, but the amount is not going from my bank account because on that particular day, the check is not presented. Maybe subsequently he'll present. Similarly, I get a check from a party. That is check number 101. Now I'm writing, because I got the check received, check is a negotiable instrument. It is as good as cash. So I write in my bank account 2,000 because we got this. But this check was not deposited in the bank. So there is no corresponding deposit here. It will come only when this amount is deposited. So till that date, there will be some difference. Okay. Now, again, another transaction on December 15. Look at this transaction. Interest on investment. We had an investment with a bank, and bank on December 15th gave us an interest of rupees 5,000. So that is our increasing our balance. They show it, they are crediting it to our account. Wherever the amount increases, it's a credit. Wherever the amount reduces, it's a debit. So they are giving us a credit for 5,000 based on the interest that we got. But this is not coming corresponding here into your cash book. Here it has not come as your deposit because on that particular day, we are not sure about that amount coming. We might have got this only subsequently. Clear? Now, again, one more transaction. Bank amount, party directly deposits. Instead of giving the check to us, the party directly gives the check to the bank. And the bank is crediting the account because the party says, I'm giving this check in the name of such and such business. Bank is crediting the business's deposit account. So there's a credit here, it comes here. But we are not sure, we never knew that on 28th this check was due. We might come to know only after subsequent days, maybe 2 days, 3 days later. So till that 2-3 days, there is a difference. So what are we trying to say? What are the reasons for difference? Some check might come to us, which is deposit, which we keep it with us, but it is not given to the bank on the same day. Or some checks might have been given to some party, but the party is not presenting it on the same day. Or bank is giving us some interest, which is not known to us on the same day. Subsequently, it might be known. Or bank is charging some interest from our account for some services that they have given, but it is not known to us on the same day. But when it is known and the two things happen, as we saw in the first transaction here, salary, there will be an equal amount coming on either side. So these are the reasons why we have to prepare a bank reconciliation. So what is happening on one particular day? Suppose on one particular day, one more transaction here, collection charges. Bank is imposing collection charges. They put a debit, 200 rupees. But we did not come to know about that on December 29th. So these are the cases where discrepancies come. So what is happening on a particular day, we would like to reconcile the two accounts. We want to bring the two accounts to a common, we want to find out what is the reason for this difference. Now, if you look at this difference, here it is 50,000 plus 2,000, 52,000, 3,000 goes, so 49,000 is the balance. But here the balance is 54,000. For every transaction, each side, there must be a corresponding thing coming up. Now, the reason for that is these transactions, 1, 2, 3 over here, and this 1, 2 over here have not gone into the, have not happened on the same time. So then we have to prepare what is, one more interest is given, 1,000. So I just gave some examples. Go on in that form. Now here also see the total is 52,000, whereas here the amount balance there is 49,000. After all these transactions, your bank account, the business's bank account is showing a balance. This is what should be the balance according to the business, 49,000. But the balance that is shown here is 54,200 rupees, which shows that there is a difference. That difference is happening because corresponding transactions are not coming to the notice of the business on the same day. Something which happens in the business does not happen in the bank on the same day, or something which happens in the bank on a particular day does not happen with the business on the same day. So they want to reconcile this balance and see how they have reconciled this. They are starting with, earlier we saw here, the balance in our cash book was 49,000. So we write that. And what are we doing? We are looking at those checks, check number 12, drawn but not presented. If the checks have been drawn and they have not been presented, that means your cash book has come down, but bank has not come down. So to that extent, you go on adding. Again, amount deposited by Mr. X in bank, he deposited an amount and deposited in the bank, but it is not known to us. So bank balance is high, cash balance is low, so you add. So whether you should add or deduct will be based on how it has impacted this initial balance. You can start with your bank balance or cash balance. If you start with the cash balance, you must see how each of the transactions has impacted that cash balance. When somebody presents a check, gives a check to a party, and that check is not presented, that means your account has gone down, the other party's account, the bank passbook is high. So you have to add it up. When amount is deposited to the bank, but not when amount is deposited by X in bank, but it is not received in the cash book, passbook is high, cash book is low. So to equate, what should we do? Add. Again, interest on investment. It was given by the bank. Bank gave credit. Bank's balance is high. Cash balance is low. So to equate, what should do? We should add. So you add, these are the three items to be added, 7,500. Now collection charges. Bank debited our account. Bank passbook went down, but we did not know about it. So our balance is high. So to equate, what should we do? Less. Again, interest. Uh, in the case of interest that is coming out, these are all transactions which are actually there over here. So when you're talking about interest on investments, your that interest of rupees, sorry, this is interest charge. So bank has charged interest, they have reduced their account. Our balance did not come to our notice, so ours was high. And then you have a check deposited by us, which was not actually cleared over there. So to that extent, your balance will be showing an amount which is higher. So these are the things where your balance is high. So to equate, you are reducing it. And finally, you do the additions and reductions and you get 54,000. So from this balance, which is your cash book balance, we reached at the bank balance as in the passbook. And the two balances are actually reconciled over there. So this is how a bank reconciliation statement is actually prepared. Your interest on the fight off. So these are the two, you look at the differences. So here, what is going to come for your multiple choice question is, what are the causes for this difference? And how do you see whether it should be added or deducted? It is based on what you, suppose you start with the passbook balance, you put this 54,000 rupees here. Then what you do here will be the reverse. What is added will be less and what is less should be added. And then you arrive at 49,000 over here. So this is how a bank reconciliation statement is actually prepared. Now again, for your multiple choice question, keep in mind that what is the difference between conventional bank accounting and the accounting that you do today. In the accounting that you do today, the many factors, not that there is no need for reconciliation, but the many factors which cause this discrepancy might not happen because of an automated form. That means it will become, the difference, suppose you present a check, give a check, you have a real time transfer, same day it can be transferred. Because why there is a difference, you give a check to a party, that party has to go to the bank, you have to give it for collection, the collection banker has to send it to the bank for collection. It might take 3 days, 4 days, 1 week and things like that. But when you have an automated system, something like internet banking, most of the fund transferring and all will take place by bank through the electronic form. So this difference in the time span which happens, the difference, if you look at all this difference, it happened because of time span. Here, this case, interest on investment, bank gave a credit of 5,000 rupees, but we did not come to know about that on December 15. Or amount deposited, a customer deposited 1,500, but we did not come to know about that in December 28. Maybe after 4 days, 5 days, we got it because those issues come here. Again, when check number 12 was given on December 3, that party kept the check with him for 1 week and only after that he credited. So till that, nothing will come over here. So what I'm trying to say here is, this discrepancy because of time space or time lag is not that high, because many of these things, people don't directly issue check to a party and the check party taking the check to the bank. They make direct transfer to the bank. So same day itself transactions will happen. So when you're using an automated electronic mode for a payment, rather than using checks, interest credited same day, they'll see in their bank passbook, the business can see it in their accounts the same day. So the need for this many times of reconciliation perhaps might not come up in an electronic banking as well as an electronic business platform, where the business is doing their banking transactions in an electronic platform, and the bank is also doing a reciprocal through the electronic route that they actually follow. Now I'm just doing a bit on what actually is the cost of depreciation, and then we'll move into an introductory part of your final account, only in terms of meeting your MCQ requirements. So depreciation part, I'm actually stopping the sharing part because the rest of it is simple in terms of the explanatory part. So we will discuss this from here onwards without actually looking into the slides. So we will actually reduce this and come to the, without sharing, we'll come into what we are actually discussing. Now, in depreciation, again, you know what is depreciation. You might know the entry. But in MCQ, issues come up in terms of what is the purpose of providing for depreciation? And what is the difference between depreciation and depletion? Now, depreciation, there are two, three reasons why we provide for depreciation. One, it is the decrease in the value of an asset because of wear and tear. Two, this is something which is known. It is something which happens because of passage of time. There is a decrease in the value of an asset just because time has passed. There is no wear and tear. Suppose I buy a very brand new car. Wear and tear will come only when the car is running on the road. I'm not using this car at all. I'm just keeping that car like that, and over a period of time, after say 5 months, 6 months, I want to sell. And I'm saying that there is no depreciation, there is no decrease in value because it's a brand new car that has never been put on the road. But just because 6 months have elapsed or 6 months have passed between the day in which I purchased, the value is decreasing because of passage of time. And this happens in many cases like intangible assets also, which we call amortization. So three words there: depletion, depreciation, and amortization. The decrease is based on the type of assets. Suppose I say fixed assets, it decreases basically because of wear and tear and obsolescence. Whereas if I'm taking intangible assets like licenses, patents, copyrights, they are given for a period of time. Because they are intangible, there is no wear and tear for it. But it is given for a number of years. And its decrease is based on the years which have passed by. Suppose I take a license for 5 years. After 1 year, its 1/5 value goes down. 2 years, 2/5 value goes down. So there's a passage of time which is decreasing its value. This is called amortization. So amortization happens for intangible assets. Whereas for tangible assets like fixed assets, you have what is known as depreciation, which happens because of wear and tear, can happen also because of obsolescence. Now, what do you mean by obsolescence? Becoming obsolete is something which is happening because of technology. Which is very relevant today. I have a fridge, or I have a television, or I have a mobile phone. A new model comes and the old model becomes obsolete. It has got no value. So suddenly it gets depreciated because of obsolescence. So obsolescence or becoming obsolete and wear and tear is the cause of depreciation. Passage of time is the cause of decrease in the value of intangible assets like license, patent, and copyright and all. And there we call it, we don't call it actually depreciation, we call it amortizing those assets, although in your balance sheet, maybe we are using the same term. Third term is depletion. Depletion comes for wasting assets. What do you mean by wasting assets? Assets which remain intact as long as you don't extract something from it, like mines, oil wells. They don't have wear and tear. They don't have passage of time also. They don't have much of obsolescence, but it decreases based on how much you extract. The more and more you extract, it gets depleted. The decrease in the value of such oil wells and mines is what we call depletion, because by use it comes down. So these are the different forms in which the value declines. So also keep in mind that although there are different methods which you can provide depreciation, some of these methods, like you follow the straight line method, the diminishing value method, the annuity method, and all, but most of the organizations which are statutory in nature, they prepare it under the diminishing value method or the written down value method specifically for fixed assets. The reason for that is not that you cannot make, we saw consistency where we said that whatever principle, not only depreciation, whatever principle you follow, it must remain consistent for a reasonable period of time. But there again, something which is turning out to be material is the fact that when we are talking about these things, we have to understand that the decrease in the value is something which we show as per certain other statutes. The accounting is saying you can show written down value, you can show straight line method, but you keep it consistent for a reasonable period of time. The problem is some other acts, say for instance, Income Tax Act, it does not recognize straight line method. So even if you prepare under the straight line method, accounting wise it will be correct. but the income tax authorities might not approve. So normally we follow the method which can be or which is approved by statutes, different statutes. Like what can happen under GST, what can happen under income tax. So based on the income tax law, we normally go by the written down value method of preparing your depreciation cost. So this is what is actually meant by depreciation. So there is a consistent difference. The causes, multiple choice can come. What are the causes? How it happens? Why it happens? And what are the basic principles of providing? So for fixed assets, it will be wear and tear. It can be obsolescence. For depletion, it will be the use or the extraction. And for amortization or for time intangible assets, it will be the passage of time, because these things are actually based on how much time they use it. So once you have passed your adjusting entries, and once you have adjusted you after preparing your initial journal, you see that the some amount should be given for depreciation. You pass an entry for that. Some amount should be given for provision for doubtful debts. Based on the conservatism principle, you are anticipating certain things to be bad debts. You pass an entry for that. Some certain things, outstanding expense, prepaid expense, you pass all these things. Now we come to the part of what is actually called the final accounts. The final accounts means it is something which is prepared, unlike a journal which is continuously prepared. This is prepared at the end of the accounting period, and it is to know the summative result of what happened in the business over a particular period of time. Now, for that, what are we actually doing? We're preparing two statements: profit and loss account and the balance sheet. Now, remember, when you say profit and loss account, this has got, again, it is split into two. The first part is called the trading account or the manufacturing account, based on what type of business you are. A business might be making something, or the business might be trading in something. That means they buy and sell, they don't make anything. If they're just buying and selling, the first part will be called the trading account. If they are buying raw materials, producing and then selling, it will be called trading and manufacturing account. Second part will be called the profit and loss account. And then you get the first result, you get the gross profit or the gross loss. Second part, you get the net profit or the net loss. Now, essentially, you should understand, first of all, why should we actually prepare this in two parts? Why can't we prepare it in one part? It will make no difference. Suppose you put all your expenses together on the debit side without looking at gross profit, sales and all the income on the credit side without looking at the gross results, you will get the same net profit. But what is the idea behind putting it in two forms? The trading and manufacturing first form, the profit and loss account separate form. The idea is to find out what is the result from your operations and what is the end result. The result from the operations means the results between the difference between buying and selling, or making and selling. If you're a manufacturing sector, you buy raw materials. So what is done there? You have your opening stock, you have your purchases, you have your direct expense, you have your sales. Up to that stage, if you look at the results, it talks about what is the operating result. That means between purchases and sales, after adjusting stock, have you made a profit or a loss? Why should we know this? Because that is the operating result. It is the difference between the cost of the goods and the sales. Only that is considered. And it takes into account only direct expense and direct income. At that stage, it indicates your operational efficiency. So if you have a good gross profit, keep in mind, these are again MCQs which can come up. You have a huge gross profit. Maybe you have 90% gross profit ratio. That means you purchased at 10 and sold at 100. You made 90 rupees per 100 as profit, gross profit ratio. That means your operating result is very good. But you might have a number of indirect expenses like sales, like advertising, like your adjusting your depreciation. You can have a lot of other rent paid. All that can come as expenses. And then maybe your final profit has come down. Now, here the profit has come down essentially because of indirect expenses. which could relate to selling, administration, and so on. So fundamentally, operational wise, everybody will like to know what is happening because of the basic operations in terms of purchases and sales. That's why we are balancing it at the first stage and finding out gross profit. That means the difference between cost of goods sold and sales and finding out the operating result. Then we want to know the end result because it is based on the end result that you finally decide, okay, what dividend should be given, what external decision should be taken. But that is after impacting this gross profit again gets impacted by a number of indirect items. So if you have a high gross profit and a low net profit, what does it indicate? Multiple choice wise, it indicates indirect expenses are high or administrative and selling expenses are high. If you have a high gross profit and a high net profit, it indicates that these impacts are less. If you have a very small gross profit and a huge net profit, it indicates that your profit is not coming from sales, but it comes from other income. So MCQ wise, you should understand what is the relevance of this profit and loss account. The relevance is it shows first level, the difference between purchase sale or manufacturing and sales, whether you have a gross profit or a gross loss, and what is the net result after considering all the selling, distribution, and administrative part. So these fundamentals are things which are actually covered over there. Now, when you prepare this statement, all your revenue accounts, your expense and income accounts gets transferred into this profit and loss account, whereas all assets and liabilities will go into the financial position. They are not closed; they are transferred to the next year, whereas all expenses and incomes are closed by closing entries and they are brought into this statement. And when you do this, we consider the accrual concept. Every expense and every income must be brought to the level to which it is actually payable or receivable. That is why after adjusting entries, you take the balance and bring it to the level at which it has actually accrued over a period of time. So this is the fundamental concept of the profit and loss account. Now, profit and loss account is a period statement, again objective type. I said trial balance is a position statement to test arithmetic accuracy at a point of time. Whereas profit and loss account is a periodic statement. It is prepared for the year or for the 6 months, for a period, and it gives the result during that period. Now, when you come to the last statement, it's again a position statement. It talks about the result at a point of time. It shows all your assets at a particular point of time, all your liabilities at a particular point of time. And anytime you have an asset, you have a corresponding liability along with it. Say, for example, you bring 10,000 rupees to the business, you have cash 10,000, you have an amount which the business owes to the owner, which is called capital, 10,000. So two sides, it goes like that. Now, when these assets and liabilities are shown, along with the operating results in the profit and loss account, we tend to understand what has happened as a result of the business, whether we made profit or loss. And again, how do we stand in terms of our financial position? And there, your assets and liabilities in the balance sheet are actually, again, by accounting, arranged in a particular order. It is put in a particular order. And the order in which it is presented is what we call marshalling of assets and liabilities. The word came from the defense forces. Marshalling in defense means, that's again your objective type question, arrangement of troops in the army. So they arrange them by height. The shortest person will be in the front and it goes on scaling up to the end. Similar to that, when you arrange your assets, you should either go by liquidity or you should go by permanence. Two orders. Liquidity, just like troops are arranged based on their height, you take the most liquid asset first and the least liquid asset last. Say, for example, cash is already liquid. Liquidity means the power to create cash on demand. So cash is already liquidity. Next easiest thing will be your bank balance. Then comes maybe uh, your debtors, because they're going to pay you immediately. Then comes your stock, then comes your furniture, then maybe your machinery, and then land, building, lease, liquid. So you're going by that. If you're going by permanence, that which is permanently held will be shown first. So you show land, building first, and towards the end, you come the other way down. So also your liability side, you will either show the liability which should be discharged first, like creditors, bills payable, and the liability which should be discharged at the longest duration, your long-term loans last. So there is an order in which you are trying to put this. And looking at that order, ultimately we are in a position to judge the financial position of a particular business. This is what happens in the process of preparing the balance sheet. It shows where you stand. It is not just showing your assets. I have this much assets. It also shows the net result trading, which is suppose you made a profit, the profit will add on to the capital. If you made a loss, the loss will reduce the capital. And you have these forms in this. You have these assets which are tangible assets, intangible assets, or fictitious assets. Tangible assets means assets which can be seen and felt. Intangible assets are valuable assets which cannot be seen and felt. Say, for example, goodwill, patents, copyrights. They are valuable assets, but you cannot see and touch. These are called intangible assets. The third category of assets are called fictitious assets. They are called fictitious assets because the word has come from the word fiction. And fiction is the opposite of fact. Fact means something, FACT, something which is real. Fiction, something you might have heard about science fiction and all. So some of the assets are actually fictitious assets. What do you mean by that? These are the assets which are past accumulated losses, which should be written off over a period of years. And until they are written off, they are shown in the balance sheet. Say, for example, discount on issue of shares, preliminary expense. They are past accumulated losses, which sometime over a period of time, it will be slowly taken off. This is what we mean by fictitious assets. So the balance sheet might have tangible, intangible, and fictitious assets. The liability might show this different classes. And when you look at corporate entities, they don't show the financial statements with the same headings that we actually see from the books. Say, for example, instead of liabilities, they use the word source of funds. Your short-term sources, long-term sources, your creditors, your bills payable, your short-term loans, sources of funds. And instead of the word assets, they use the word application of funds. So your funds are put into long-term assets, fixed assets, so on and so forth. And there are different forms in which you can present this. The balance sheet can be conventionally what you see in the books is what we call the horizontal form. It goes like this. They are shown side by side. But there is also a vertical form in which you show the sources of funds, and under that you show the application of funds. So it comes one after. That's called the vertical form. So whatever be the form, the basic concept is the same. And what we saw in your initial concepts, like say separate entity, that is reflected when capital is put on the liability side. When you say materiality, that is reflected in terms of showing things appropriately in terms of what is important at a particular point. We saw credit sales, cash sales. What we're trying to say, accrual, that comes in adjusting entry, and the adjusted payables and receivable amount is shown in the profit and loss account. What we talk in terms of consistency is maintained in the principles that we actually follow when we prepare the financial statements over a period of time. So this is the entire concept of accounting. It is to give full disclosure about what actually has happened in a business over a period of time, using how they have actually used their funds and what results they have produced. So there is an initial diary kind of thing, which is a journal. There is a classified posted ledger. There is a testing part, which is the trial balance, and there is a profit and loss account and balance sheet, which is a financial statement. And in between the journal and the final thing, you make some adjusting entries to bring the figures from what is paid to the payable, what is received to the receivable, and you get a summation part. There is also a concept called conservatism there because all anticipated possible losses have been accounted in that concept. So this is the first part, the initial part, which is very important for your paper in accounting. It's just basically things which have been in a very simple form dealt with in your +2 classes. But then what is important is how you conceive the concept. It's not by learning by rote. Without understanding, you learn materiality, separate entity, going concern, money measurement. But you need to understand what it means when it comes. As I said, I was talking about the concept. I said how it comes to the your process of journalizing posting, how it comes to the process of testing, how it comes to the financial statements. So those things will be put in a MCQ format. Which are the errors which will come in the trial balance? Which are errors will come which will not be revealed by trial balance? Being revealed by trial balance means showing the difference. Not being revealed means it does not show it. We must conceive it in that form and be prepared to take questions which are going to give you the meaning of what it is. Nowhere you're going to get direct questions like what do you mean by ticket? What are the rules of it? It will not be like your university examination question. Contrary to that, it will be in the nature of applications through multiple examples. And they'll ask you to identify whether this is consistency, whether this is on that form. So make your preparations on that line and do well on that particular line. So this is what we have to cover today based on the class that we one first part. Maybe tomorrow we'll be looking into a bit into the non-trading concern. We cannot cover, as I said, the entire principles. We are only giving you some cues on how you can approach the coverage part of it and how we can actually prepare for the examination. So on that count, because otherwise it's a very long curriculum, we'll be discussing a bit about non-trading concerns, consignment, joint venture, and some introductory part into costing. That will more or less, or what I would say rather, by and large, be covering your content for this particular examination. So this is a national account. I encourage your friends also to take the examination because just at 300 rupees, you will be getting the potential to participate in an all India test, and you can show this when it comes to your employment as well. So thank you so much for your participation. Now, if anybody would like to ask something, you can do that now. Otherwise, we will again join back tomorrow. I think you have the same link, or if there's any change, I'll let you know through your group which has been created for this. Now, anything anybody would like to add or ask or share or suggest or anything on that count? Anybody has got anything to ask?
So,
yeah.
There's a question in the text box.
What is that? Yeah, I can just read it out.
Sir, can we refer the old textbooks of +1, +2 for reference?
Definitely. Old textbooks, but as I said, remember, it is not going to be nowhere because this is only MCQ, multiple choice question. You are not going to get a question like what are the rules of debit and credit. Perhaps there might be a question like somebody has purchased certain things. As I said, say somebody has purchased goods from A on for cash. The account to be credited is. So there, when I said for cash, A becomes immaterial. So the account to be credited should be cash. Or the other way around. Somebody has purchased goods from A on credit. The account to be credited in that case will be A because we are not paid cash. So they won't ask you the rule, they'll ask you the implication. Similarly, as I said, they won't ask you what is separate entity. They'll say which of these things actually happen in a business because of separate entity. Capital coming on the liability side happens as a result of separate entity. They'll say, why are we actually passing? They won't ask what is an adjusting entry. What is the purpose behind having adjusting entry? Accrual. Bringing the values to the value which is due for a particular period. So what I'm trying to tell you is your +2 examination and maybe even your BCom examination, we are more accustomed to learning by rote. So we just reproduce what is in the books and you get marks, even perhaps without understanding where it happens, how it happens. So the implications of the whole thing is more important. Why are we showing the details of all salary along with the salary statement in a profit and loss account? Full disclosure. Why do we show cost, less depreciation, Why can't we show the written down value alone in the balance sheet? You'll get the same answer. But we are showing cost less depreciation through a statement, which is an added appendix to the balance sheet because of full disclosure. So these are things which we need to understand in terms of implication, and that should be the modus operandi when you're preparing for this particular examination. So that you have to keep in mind. Similarly, they might ask you some of the errors, some of the things which get revealed in the trial. Which among the following will get revealed through disagreement in the trial balance? Which among the following errors will get revealed through disagreement in the trial balance? Total omission will not get revealed because there is incredible. Partial omission will get revealed. So those are the things which you need to keep in mind when you are trying to prepare on that particular line. Any other question in the chat box?
So there is a technical question
Yeah.
that somebody wants to get the refund. Actually, they made the registration by mistake.
That you'll have to contact the coordinator, Mr. Banawat. This is not done in Kerala. This is done from Udaipur in Rajasthan. What you have paid is what, 300? You mean to say that you don't want to take the examination, or what? You paid the amount but don't want to take the examination?
Sir, I will read the question. Sir, I am student who is now doing 6th semester BCom, but I didn't complete it. While making payment for exam, I paid 600 rupees by mistake, as it is only for those who completed third year. Is there any way I can get the refund?
There is no loss in terms of your examination. Your problem is if you have written in that examination senior level, you can't take senior level examination because you have not completed BCom. For the senior level, you have to show the undergraduate certificate. So because in your 6th level, you can do one thing. You can, Reshma, if you can get that person's number and I can talk to the coordinator who's in Udaipur and try to put you into the junior level and get a refund of 300 rupees because for the junior level, you need to pay only 300. But then you give your details because without the details, they cannot do that. You pass on the details indicating your registration details and the payment details and through the portal, and based on that, I try and talk to the Mr. Banawat from Udaipur. He's from Rajasthan. So they are doing the coordination. The coordination part takes place from Rajasthan, but the examination is held online across the country. Anything else?
So there is only one more question that the recording is available of this class. That will be available in YouTube. We will be uploading that in YouTube, and the link will be shared in the group.
Definitely.
One more. So there's another question by Atul. Can you say something about cost accounting and management accounting? Would they ask from those subjects?
Management accounting, no. Cost accounting, yes. Cost accounting, the basics only. It's not much. It's more into accounting, a bit of cost accounting. Say, for example, what is the cost center? What's the cost unit? What's the cost sheet? Those things like that. Management accounting is the use of this accounting principles, like finding out sources and application of fund, finding out the ratio-based analysis and all. That means accounting information is being used for managerial decisions, but that is not included in your curriculum. Cost accounting, yes. Any session for what? What is that? One other question. Reshma, I could not.
Any session for seniors will be provided.
Seniors, because the seniors number is relatively less, we have not taken up seniors. But if there is a demand, yes, we will do that. But then we need to know how many people will participate. I think for this also we had a registration of more than 200, but participation was 120 or something like that. So we have to, unless there are people who are truly interested, because we are giving this free orientation, we are taking our time and energy. Fundamentally to create awareness. So you should be the torch bearers to your respective institution on how people can take this, what do you call, different tests. Keep one thing in mind, which I keep telling students across. Days are changing now, and it's not just an academic degree which is going to support your employment. You need to have lots of skills. You know, there is something like Kerala Knowledge Economy Mission, which is talking about accounting skills. So just because I'm saying that I have passed an accountancy paper with 90% or A++ grade, where my basic accounting skills are not getting manifested, you are not able to get into a career. So we are trying to enable you to participate in different kinds of skill-based tests, and you get some certification on that. That is where you're going to find yourself to be more skilled for a job. I hope I've made myself clear. Anything else? Now, any more questions which have been left unanswered?
Sir Sharon has asked the question again. Sir, I paid the registration fee, but the website is not corresponding. What to do? That is, it is not
See,
verifying.
those things you can just give it to me or maybe to the WhatsApp group with your details, because as I said, we are only giving a what you call orientation for the examination. The website and the organizers are all at the national level, and the website is being what you call maintained from Udaipur. But still, you could pass a mail to it. I'll pass it on to the host and see whatever is possible can be done. So if there are no more questions, shall we conclude for the day? And hopefully, I believe all of you will join again tomorrow, because again, we are trying to look at implications. We are like trying to look at what you call how accounting actually goes into perspective, and we are trying to see a bit of costing also, which will be integrated with this. But I don't know how much time we'll get, but we'll try and look into that. As I said, there's also you must also understand the gap between how is it initially transacted when it was in a manual format, and how it actually, I was referring to the bank reconciliation statement. That much of gap which was initially there does not happen when I use internet banking and when the bank uses a platform. So instantaneously, that's what is called real time. It happens at the same time. So the reconciliation processes are relatively less when we go by the automated mode. Okay, if there are no more questions, shall we conclude, and thank you. And yes, we will come again. Any more questions?
How do they give us certificates? Is it via
It
internet?
is. It is all online. Entire process is online. You will download your certificate after passing. It will show your grades. It will show your marks. It will show whether you are in the first 10%. All that will come into. Then, if you come into the merit of trophy and cash prize, you will be invited for the All India conference, which happens once in a year. And incidentally, this year's All India conference is in Trivandrum. Otherwise, last year it was in Gwalior. Before that, it was in Jaipur. So it happens in different parts of the country. And you are getting a certificate from an All India agency. It's not just from one college or a university. It represents an All India body. So that is where you have an added advantage of it. So if there are no more questions, shall we conclude then in that case? Reshma, shall we stop?
Yes, sir. I think there are no more questions. So thank you so much, everyone, for participating. And of course, thank you so much, Simon, sir, for your wonderful session. Now we can meet again tomorrow at 6 p.m. for the day 2 class.
Thank you.
Once
So
again, thank
bye and good night to all of you. Thank you.
Good night, sir.
Thank you, sir.